Hi, and welcome to this week's market presentation. Latest news. In the latest developments regarding the US-initiated trade war, the broad-based tariffs against 90 countries have come into effect as of last week, starting on August 7th. These countries will now be facing tariffs on their exports to the US, ranging from as little as 10% to as high as 50%, as in the case of India and Brazil. The tariffs are expected to weigh on global economic growth as they reduce economic activity. Negotiations between China and the US continue this week with the fast approaching deadline of August 12th to reach a deal before additional tariffs could potentially start to kick in. In terms of the expected meeting between President Trump and President Putin in Alaska on August 15th, a lot of questions remain surrounding what the outcome of the meeting will be. Russia has continued to maintain its pretty maximalist aims and demands in any negotiation, and President Zelensky and Ukraine have already shut down the idea of territory concessions towards Russia. The outcome will likely have an important impact on energy markets, particularly as it relates to the imposition of additional tariffs on Russia, as the US has threatened if no peace deal is reached, as well as the prospect of secondary tariffs on countries that continue to import Russian goods, primarily Russian oil, as in the case of India and China. Weather. Moving on to the latest weather forecast, temperatures across most of Europe are forecasted to see above average temperatures over the next 7 to 10 days, with Western Central Europe expecting to see temperatures upwards of 8 to 10 degrees above the seasonal average. Precipitation will be quite limited over the same period of time, which for the Nordic regions and those countries more reliant on hydropower generation will see that have a bullish impact on markets. Lastly, in terms of wind speeds are similarly expected to remain on the lower end of the spectrum, likely weighing on wind power generation as well. In terms of the Atlantic hurricane outlook, we see potentially an uptick in hurricane activity in the Atlantic, although for the moment, the probabilities of tropical storms of hurricanes forming remains below 40%. Macroeconomics. Recently released July 25th PMI figures for the global economy have shown a slight increase in the composite PMIs, indicating continued growth globally. While looking at the manufacturing sector in particular, we are seeing that dipping below the 50-point level, likely or potentially as a result of the tariffs the US has imposed on its trading partners. Taking a closer look at the PMI figures for select countries, we note a worsening outlook when it regards to the manufacturing sector, while the service industry continues to maintain its growth position, helping minimize the negative impacts of the slowdown in the manufacturer and industrial sectors. In terms of inflation, we saw inflation figures be released for China, showing the Chinese economy continuing to battle the deflationary pressure that has impacted the economy over the last couple of years. Crude oil and LPG. Looking at crude oil markets, we saw a retreat of prices over the past week, with the October 25 product down nearly 4.5% for Brent and almost 5% for WTI. Further along the curve, prices similarly retreated, although somewhat more modestly. The decreases in crude oil prices likely impacted by the imposition of those wide-ranging tariffs against those 90 countries and the potential negative impact that it will have on global growth. The disappointing growth and labor market figures out of the US for the first half of the year, similarly adding to some of the more pessimistic sentiment in the market. Additionally, weighing on prices is the continuing decision by OPEC Plus to increase production quotas month over month. In terms of the petroleum balance outlook globally, we continue to see expectations of an oversupplied market through the remainder of 2025 and through 2026, adding to the better sentiment in the market. Natural gas. Looking at the natural gas price evolution next, we see a bearish price evolution over the past week, with prices decreasing both for the remainder of 2025 and further along the curve as well. The front-year price saw a decrease of 4.2% on the week, continuing the bearish trend we have seen over the past few weeks. For along the curve, the decreases became more modest. Looking at the fundamentals, European gas storage levels have continued their upward trajectory, ending this past week at just under 72% full. While we have seen continued improvement in these storage levels, the deficit versus the previous year remains relatively high at 15.5%. Although when we look at the level of injections into storage, those are still near the top of the range over the last 13 years and still above last year's levels, indicating a continuing decrease in the deficit versus the previous year. Given current injection rates into storage, we're still looking at an adequate pace to reach the European Union targets on schedule. In terms of total supply and demand, we've seen a decrease in both over the past week, particularly looking at total demand, as overall gas consumption has waned week over week, now to the lowest levels over the past 5 years. Total supply has seen a similar decrease over the past week, slightly remaining above last year's levels. In terms of the supply mix, we've seen a similar trend over the past week, and more interestingly, looking at the different sources of natural gas, we see Norwegian gas flows remaining at the top of the range over the last 5 years, increasing compared to a couple of weeks ago. On the other hand, we can note the continued decrease in LNG send-out, which are in line with the sharp decreases in LNG imports into Europe over the past month. Lastly, we have seen a slight uptick in North African gas flows into Europe, moving above the past 5-year average. One of the factors leading to a decrease in LNG imports into Europe is the greater price competition with Asian consumers. Part of that is the seasonality of gas demand in Europe and Asia, but the other factor is the greater gas burn that we're seeing in Asia, resulting in additional demand for LNG imports into the region. In terms of investment fund positions, those have come down in line with the decreases we've seen in the price level for TTF. Coal. Coal prices over the past week fell across the board for the forward year, following a similar evolution as natural gas. For Europe, those decreases amounted to roughly 2.2% on the week. EU and UK emission allowances. In terms of emission allowances, those saw an uptick for the European market of 3.1%, while in the UK market, while spot allowance prices remain stable week over week, there was a slight uptick again in the December 25 product of 3.8%. On the European side of things, as we approach the compliance deadline, it is typical to see an increase in demand activity, and as a result, we do see that add a little upward pressure on the market. Keeping those increases from going further up is the fact that power sector emissions in Europe have remained at the lowest levels in over 5 years as of the end of last week, as shown here. In terms of investment fund position, those in Europe remained more modest compared to the high net long positions we were seeing earlier in the year. While on the UK side of things, net long positions remain near the record highs we've seen throughout the year, as expectations of the linkage between the European and UK markets continue to add support to those long positions. Electricity. Looking at electricity prices next, we see more limited movement than we saw with natural gas prices, with the 4 years in particular seeing pretty minimal movements over the past week. The decreases were more pronounced in 2025, as the Q4 25 quarter, for example, saw a decrease of just under 2%. Here, the bearishness in gas markets being counterweighted to some degree by the uptick in carbon allowance prices. Looking at the price evolution across other European countries, we see a similar trend with a slight decrease across most markets, one of the exceptions being in Poland and also in the Nordics. In Nordics in particular, the decreases are certainly being limited by the drier weather forecast, worsening the hydrological balance outlook. In terms of total demand and residual load, we see those near the bottom of the range over the past 5 years, also adding to the bearish sentiment that we saw over the past week. In terms of the European supply mix, we've seen the improvement in the French nuclear power fleet output increase the share of nuclear generation across Europe, as well as the continued increases in the share of solar power generation reaching record highs, and also the way that the uptick in wind power generation has helped limit the ongoing increases in the share of fossil fuel power generation. In terms of French nuclear power output here, we see that it is near the top of the range over the past 5 years, just slightly below last year's levels. In terms of renewable power generation, we've seen a pretty stable evolution over the past week, remaining at the highest levels we have seen. On the other hand, fossil fuel power generation has remained at the bottom of the range over the past 5 years. In terms of the renewable power generation mix, we have seen a slight downturn in wind power generation, although it has remained noticeably high for this time of the year. That decrease has been then met with an increase in solar power generation after the previous week had relatively disappointing output figures. Solar power output is now once again at the highest levels for this time of year. Lastly, looking at the hydropower generation there, we see that continued decrease in hydro reservoir generation week over week to the bottom of the range of the past 5 years. In terms of fossil fuels, we do see a slight uptick in fossil gas generation as a response to the warmer weather and the slight uptick in total demand for electricity. On the other hand, it does remain at the bottom of the range of the past 5 years. Decreases in coal power generation can also be appreciated, particularly looking at brown coal and lignite generation, while fossil hard coal generation has also seen a decrease compared to a couple of weeks ago. As looking at hydro reservoir levels across Europe, we note a worsening outlook, certainly compared to the more optimistic situation we had just a few months ago, particularly in the Nordics. We are seeing hydro storage levels starting to get closer to the 5-year average at a time of year where we typically see a further increase in hydro reservoir levels. And lastly, looking at the guarantees of origin, while we do see more volatility for the 2025 production year over the past week, with prices increasing between 8 and 11% on the week, prices further along the curve, starting with 2026 onwards, are seeing more limited volatility. In the shorter term, as market participants settle their positions for the year ahead, we are seeing additional buying activity, adding to the volatility in the market. Adding to the bullish sentiment in the market is certainly the worsening outlook for hydropower generation in Europe in the second half of the year, as those hydro storage levels get closer and dip below the past 5-year average. That covers this week's market presentation. Thank you for joining.